Good day to all. Okay, today we are going to discuss about an important topic: portfolio management. Or you see, in this share, people are losing money. Some people are making very good money. So, is there any strategy by which you always will make money? That is a question being asked by different analysts. So, to answer to such a question is one way is portfolio, constructing the portfolio. Constructing portfolio is a way by which you can earn profit consistently and continuously by in the stock market. It is a it is an excellent way. See, first option trading, buying the stock, selling it to profit, investing in mutual fund. A lot of ways are there. And one more way, one important way that gives a solution to you to make a continuous profit is portfolio construction. Okay, welcome to Dharani Capital. In this video, we begin our series on portfolio management. Today's focus on introduction to portfolio management, understanding its fundamentals and core activities. So today we are going to discuss about this issue only, how to make profit consistently. First, what is the risk? Let us understand the basic concept. Risk is, suppose we are expecting something, say around 15% from an investment, but the investment will not give you 15% unless it is handled properly. Means it has a risk. It may give you minus 10% also. It may give you plus 25% also. Both the things are there. This is called risk, which is to be handled properly by us to make profit consistently. For that, portfolio is helping us, will help us. Understand? So the risk refers to the possibility that actual returns deviate from the expected returns. That the expected returns is totally different from the actual. There is a risk. For that purpose, we are using the data are collected over a period and we are calculating the standard deviation or variance. Okay, now what are the portfolio? Portfolio means you know that portfolio means is the set of shares, set of good shares in which you are investing, and those shares will have different proportions in your portfolio. Okay, see, this involves three major activities. First, you have to select the securities. What kind of securities you have to select? That is the most important thing. First, once you selected, say, five type of securities from different sectors, say 10, even 15. Some mutual funds are having 30, 40 like that also. So you are different from the different sectors. You are selecting the best possible securities. That is the first research. Second, third, you have to construct the feasible portfolios with that permutation combination that you have to put. Then once you decided these are the shares we are going to invest, then question is coming, what is the proportion? Which share we have to invest more and which shares we have to invest less? This is the third stage. All these things we will see one after another. Okay. Now, why I have to construct a portfolio? All shares are jumping, many shares are losing. We will go by we have to select the shares. Why I am constructing a portfolio means the objective of portfolio, first you have to protect your principal. Stock market is going up and down, greedy, speed, everything and that will not help. You have to first see that your capital is protected. Second, it should have a income, established income. Sometimes one day, one morning it is coming profit, another day should not incur losses. Third is these securities should give space for capital growth. The value what you invested today should be doubled in a 1 year or 2 year, whatever it is. Depends upon your investing goals. Marketability. The shares what we are selected is should have the marketability, means it has the liquidity, means you can sell it anytime. Must be a blue chip company or highly reputed company for which you can always buy the buyers. Diversification. Diversification is an important to manage your unsystematic risk. What is a systematic risk? Unsystematic risk, I already explained in a different video. The systematic risk is the risk which is operating for the market throughout. War declaration or major activities, interest is reduced, like that and all, it will affect the whole market. Whereas the unsystematic risk means it is the risk that is specific to a particular stock or company. For example, a company is operating in automobile sector. Some new innovations and all came. Because of that, the two-wheeler itself becomes obsolete because of the EV vehicles are introduced, like that and all is there. This kind of unsystematic risk and all you have to cover by means of diversification. Okay, let me go speed up. Portfolio. Now, what is your portfolio is involved in 5 phases. 5 phases. The number activity we told. Now, how we are going to step by step, 5 steps we can say. First, security analysis we have to make. Then, portfolio analysis. Selection of that with the securities and shares. And portfolio revision. And portfolio. First, let us understand what is the security analysis. First point, most important part of the portfolio construction. See, security analysis is you have to identify the shares that are all undervalued or overvalued securities. Investors need to understand whether a security is priced right. What is the price it deserves for, and at what rate it is getting quoted in the market. This requires detailed analysis to determine risk-return profile of each instrument, each stock. What is the risk? How is the return? And you have to verify that. What is the way? What are the ways for that? 2 important ways are there. One is fundamental analysis and technical analysis. Okay. Fundamental analysis looks at company specifically for its earnings, how it is paying out dividends, what is the competition it is facing in its market, in its sector, what is the quality of the management, and industry performance. So intrinsic value is higher than the market price, just to go and buy it, so that the value will appreciate, so that your portfolio will make very good profit, 2 times, 3 times, 5 times, even 10 times also. I will tell you that also. Technical analysis, price movements are not random. They are following a certain category. See, it will go to the up to resistance level. Then it may come down up to supporting level. So it may oscillate between the supporting level to resistance level. So once it's what the technical analysis predicts, once it's breakout its resistance, it will jump. The same way, if it breaks its supporting level, the price will nosedive. You will lose all your money. Okay. So how to identify those things and all? Portfolio. So okay, once the portfolio with all these tasks you are established, that doesn't mean that the entire task is coming to an end. Market is dynamic. Sector is changing. Every day news is coming. All these things is getting reflected with the performance of the stock, which we are choosing from different sectors. So this we have to make it. Okay. Now, what is the portfolio? Once the portfolio, what we are selected, should give you profit consistently. That is the point. And also it should have the enough capital appreciation. For the purpose only that Hari Markowitz has developed one modern portfolio theory. It's an excellent theory. Means what the shares matter you are selected, the covariance of between these two, a pair of shares is to be worked out. Covariance should not be positive. It should be zero or it should be negative. If you are means if the price of if the market is having the bull run, almost 70% of the shares will rise. When the market is down, a particular shares are there that have capacity to rise when the market falls. So when your portfolio is having such shares that have the covariance is negative, means if one share price is increasing, another price is decreasing, another share that has the negative correlation, covariance with this share will increase so that your profit is ensured for its consistency and continuity. That is a way. Modern portfolio theory is an excellent theory. It is saying like that only. Okay. Portfolio revision. See, I told, it's not, you don't assume that everything is over once the portfolio constructed. You have to revise it due to the market dynamics. Okay. Okay, now let us, I want to tell you one small example. In 2020, Infosys was trading at 650 per share. Analyst studying the fundamentals, like consistent revenue growth for Infosys, strong digital transformation, and cash reserves. They valued the shares at 800 rupees. So a share that has the intrinsic value of 800 rupees is getting quoted at 650. Now what we have to do? You have to buy and accumulate it immediately. That is what the things portfolio is suggesting you. Okay. They say take Reliance, one more thing. Take Reliance Industries. Same technical analysis observed a breakout in April 23. The trading volume is increasing and RSI indicating strength. The stock rose from 2,200 to 2,500 in a few weeks. Means this is the technical analysis. If you are able to make technical analysis in an excellent way, definitely making money in the market is not a big thing. You can always make it. Thank you for watching this video, Portfolio Management Part 1. Stay tuned for Part 2, where we will go deeper. With the live examples, we will study it. That will help you constructing and evaluating real life portfolios. If you find this video useful, please subscribe, share, and like it. Give your views in comment. We are open and we will be continuously releasing the videos on finance side as well as share market side. Thank you. Thank you for watching. Dharani Capital from Dharani Capital. Thank you. Okay.